This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
Hi Shane, hi everyone.
Hi Diana, hope you're well.
I am, thank you, and I hope everyone else is well too. So a few changes in the Australian data scene on the economics front the last 2 weeks. The GDP figures, which tend to be quite a backward-looking indicator for the economy, actually had more of a market impact this time. And I feel like that's happened the last few GDP prints that we've had because they have been quite weak. So the data showed that economic growth was running at 0.8% over the year to September, the slowest rate of growth outside of the pandemic that we've had since the early 90s recession. And the components as well showed a pretty weak picture of the overall Australian economy. And this has led to some expectation that we could get a rate cut as early as February. So what did you make of the GDP figures? And you published a note this week as well on some of the on the productivity measures that were in the data.
To be honest with you, I found those GDP numbers pretty depressing. I mean, it's funny, as we're recording this, I'm looking out to perfect blue Sydney sky with boats everywhere. It looks perfect, but unfortunately, the economy has been struggling and many Australians have been on the back of that. And it's reflected in the GDP numbers. Yes, the economy is still growing in a conventional sense, but it's only because we've got super strong population growth still and very strong growth in public spending. If you took those two things away, we would be negative. We would be in recession. And I think many people would probably relate to that. We're not seeing it in the unemployment numbers yet, at least. But in terms of spending, consumer spending, per capita GDP, which is in recession, private final demand, excluding the impact of government, all looks fairly negative, which I guess is one of the things we've been worried about for all those years. When you did the remake of Love Actually on the video there about hopefully getting interest rates down next year. We are seeing the sort of weakness that we were worried about, but it's been smoothed over by those things I just mentioned, population and strong public demand. The other thing is to note in those GDP numbers, particularly that it is coming in weaker than the Reserve Bank expects, and that's also coming on the back of a few weeks ago wages growth numbers, which are showing a slowdown faster than the Reserve Bank expected, all of which I think is consistent with the Reserve Bank needing to cut interest rates sooner rather than later. And of course, it seems the Reserve Bank maybe is starting to head in that direction as well. We thought maybe they were pretty hawkish, in no hurry to cut rates, so we pushed out our rate cut call to May. I'm now kind of thinking, well, there's a pretty good chance it's going to be in February, which was more in line with our original view and our own economic analysis. I mean, that's often the way things are. When you look at central banks, they're trying to explain what they're thinking right now. And then when you get some data, they obviously have to be flexible and they change their view a little bit, which is what we've seen in the last week. So I'm getting more optimistic that we are going to see a cut sooner than later, which I think is a good thing for Australia. The danger is that the longer you leave rates at these sorts of levels, that the greater the risk that we will go into a conventional recession as well as a per capita recession.
One part of the data which I thought was really interesting was this clear weakness in the private sector. And it's basically the public sector that's just been propping up growth in the economy. But how much longer can public sector spending keep the economy afloat? I mean, if we didn't have that spending in the public sector, we would be in an outright recession. I think public sector funding was 0.7 percentage points of the GDP in the September quarter, and we only grew by 0.3. So if we didn't have that, then you'd obviously then we'd be negative. But can we rely on the public sector to keep growth strong in the next year?
Well, I guess, some might hope that you can, but I think that's questionable because we're already seeing a swing into deficit federally. Several of the states have fairly large or significant deficits or debt problems. So the scope for public spending to remain this strong, I think, is fairly limited. And it's also causing problems, obviously when you've got public spending, which is now at a record share of GDP. It's almost 28%, yeah. 28%,
But is that in itself a problem? If we keep on having this public sector that keeps rising as a share of the economy, what's the optimal level of the public sector that we should have?
There's no optimal level. If you're living in the Soviet Union, then you'd say it's 100%, but they're long gone and it all fell apart. It's still going. Cuba, North Korea and so on. China's in some ways more capitalist than other countries, but it's more directed capitalism. But you tend to find that there is some limit there, that if you keep expanding the size of the public sector, particularly when it's solely related, or a lot of it's related to provision of services like health and so on, NDIS, the things that we need, but by the same token, productivity in those sorts of sectors is not as high as it can be in the private sector for lots of obvious reasons, because in many cases you're just applying people and you can't apply the same amount of capital to it. And the problem is we want all those things. We want those things. We want more defence spending as well. We want more aged care spending, more health spending, more spending on the NDIS. The trouble with those things, of course, is that you're taking money away from the private sector, which then hampers growth in the broader economy in a longer term sense, because it adversely affects productivity. For two reasons. Productivity in the public sector is less than it is in the private sector. Secondly, if you're devoting more resources to the public sector as opposed to the private sector, that's less resources left over for investment, which weighs ultimately on private sector productivity. So
why is everyone so obsessed with productivity growth? I mean, if you think about a school teacher or an aged care worker or a childcare worker, it's hard to be more productive. Are you going to look after more kids? Well, no, because you have specific ratios. Or are you going to look after more older people in homes? Again, you can't necessarily do that. Or how does a teacher become more productive? Is it driven by their student results? Or teaching a big classroom? It's pretty much impossible to get strong productivity growth in those areas. But why are we so obsessed with it? What does it actually mean for people every day that are just living their lives?
Well, that's a good question, because productivity is the basis of growth in living standards. Our living standards, material living standards, I'm not talking about other things and whether everybody's happy or not, but just focusing on material living standards, we can afford to live better lives materially if we produce more per unit of labour input or produce more per hour worked. So that's what productivity is. It's growth in output, which is measured broadly as GDP. So it's consumer spending, investment, housing, and so on, even public demand divided by the number of hours that go into producing that GDP. And if you can keep growing that ratio, GDP per number of hours, then you end up with higher material living standards. You can fund more things, you can consume more, you can spend more on the NDIS and all those sort of things that we want to have. The trouble is, if it starts slowing down, and over the last 8 years, it's stalled. So normally productivity growth in Australia, at least in the 1990s and into the 2000s, was running around just above 2%, about 2.3%. And that was on the back of a bunch of economic reforms in the 80s and 90s that reinvigorated the economy. And then in recent times, it's slowed right down. In the last 8 years, it's stalled. So there's been no growth in output per person, if you like, or output per hour worked. And that means it's bad news for living standards.
So why has that happened? Is it because of all the public sector jobs that we've had in these areas that have lower productivity growth? I think it's also a reflection of over-regulation in parts of the private sector. Are there any other reasons that you think it's the case?
Well, I think there are two very important reasons. Over-regulation is a big one. And you've done a note looking at growth in the public sector employment areas like education and health. Again, I say these are very worthwhile areas of the economy we need. But potential for productivity growth is a little bit lower than it is in the private sector. And then, of course, you've got other issues as well. We've got a crazy tax system that relies heavily on income tax and that acts as a disincentive. We have a ridiculous tax of property out there based on stamp duty, which has the effect of misallocating resources. You've got older people, kids have left home living in monstrous houses. There's younger people living in tiny houses. Crazy situations there. We've got less competition in the economy. The level of competition has declined over time. So there's a bunch of factors which have contributed to this. At its core, I think, is the fact that the reform of the economy that we got used to in the 80s and 90s has basically stopped over the last few years. We have seen some reforms in that government will allocate more to education and apprenticeships and training and so on in every budget, it seems. This current government's been allocating more money to subsidising childcare, which helps women work more easily into the workforce.
Or men, hopefully.
Or men. And of course, that's part of the solution as well, getting more men to stay at home and more women to the workforce. And a big chunk of that, which will help immensely, is ongoing workforce flexibility. terms of where people can do their job and the hours they do it in. So those things are all very important. It's not just the role of government. But apart from those sorts of things, we haven't seen a lot on the reform agenda. The tax system has become more moribund. In Australia, we rely too much on income tax, not enough on the GST, all sorts of issues around that, and lots of other issues with the tax system as well. So we really basically need to reinvigorate the reform process. The other concern, and I think you've got a chart on this and you've looked at it in the past, is that business investment as a share of the economy seemed to peak in the mining boom. And since then, it's been pretty weak, which is a concern as well, because if you're not investing as much, then it's hard for the private sector to be as productive. So an argument basically is that if you want to get living standards up again on a sustained basis, you've got to do more to boost productivity. That requires supply side reforms, boosting competition, fixing the tax system, deregulation, all those sorts of things. There is a little bit of light at the end of the tunnel here, because you could argue, well, we're going through a cost of living crisis right now. People have seen their living standards fall. Often in Australia, when we go through crises, you sort of start to see reform. We certainly saw that in the 1980s. Another thing that will put pressure on Australia is Donald Trump, perversely. That's an interesting one. A lot of concern about Donald Trump. We've talked about him in the last few podcasts. But some things that might be positive out of that is that Department of Government Efficiency in the US, the DOGE, could lead to more efficient provision of government services in the US, which in turn could put pressure on Australia and other countries around the world to adopt more efficiencies in the delivery of public services. So that's one thing. The other thing, if Donald Trump gets the corporate tax rate down to, 15 or 16% or something like that, then there's going to be pressure on Australia to do something like that for our own corporates.
But that didn't happen last time, though.
I know, it didn't happen. I think we got it down for smaller companies, but not for larger companies, and it stuck at something like 30%, I think the number is. So that's an ongoing concern. We're at the higher end of OECD countries, and obviously companies have a choice as to where they locate, and they might say, well, Australia's not a good place to be. So if you get more reforms coming out of the US, it could put pressure on Australia to undertake more reforms.
Okay, so given that this is our last podcast of the year, what have been some of the highlights for you?
Well, I think the big highlight for me was just how strong investment market returns were. On my very, very rough calculation, it looks like a typical balanced growth superannuation fund will have returned something like 11 or 12%, give or take a little bit. Very strong global share markets.
Higher than our medium-term return projections of, I think, about 6%?
Yeah, way above that, way above that. Global markets north of 20% on average, of course a little bit weaker.
Driven by the US?
Driven by the US. Japan was pretty strong. Europe was a bit of a laggard. China had a surprise upswing on the talk of stimulus. That came later in the year. Aussie market did pretty well. It's had a fantastic year. Record highs were reached, but a relative laggard. Bonds sort of
better second half for Australia.
Better second half for Australia. I think the market's starting to anticipate better profits and lower interest rates ahead, even though the low rates have been delayed. So that to me has been the highlight, just how strong investment markets have been. And I think it's partly been because if you think back a year ago, we thought inflation would fall and we would avoid a recession. Guess what? That happened. Inflation did fall, but economic growth held up a lot stronger. So we got the rate cuts globally, not in Australia, but we got them globally. And that combined with lower inflation, but growth being stronger, I think propelled markets higher. But to me, the big factor X, as Don Stammer used to say, in Australia was just how resilient Australian households have been in the face, or those with the mortgage have been in the face of very high interest rates compared to the situation, say, 3 years ago.
Yeah.
So what do you think factor X was for 2024?
Well, I suppose it was that the Reserve Bank didn't join the rest of the central banks in cutting rates. And I guess the X factor to that was that the labour market held up so well, because we were basically right on everything else, that the growth would slow further this year, that you would have the consumer still being quite constrained. Inflation fell basically in line with our own forecasts, but the unemployment rate didn't rise nearly as much as we thought. I mean, we thought that the unemployment rate would get to about 4.5% by the middle of this year, and it's at 4.1% towards the end of 2024. So that has been a massive surprise. And I guess the reason for that has been the resilience in public sector funding, with healthcare and education jobs accounting for about 60% of jobs growth in the past 12 months, which has definitely been a surprise to me.
Yeah. I mean, the rates one has been a disappointment. I thought rates would have come down by now, but households haven't got into as much trouble with their debt. I think that's partly because, as you implied there, the labour market's been strong so they can get jobs. People are drawn on their buffers. Then you've had all this public spending and very strong population growth. So in that sense, you can sort of understand why the RBA has had to hang on a little bit longer. In a big picture sense, though, I mean, our colleague Mi Bu has this fantastic chart which looks at core rates of inflation in comparable countries, and we're not that different compared to the US and the UK. Canada and Europe are a little bit lower. But in the great scheme of things, we're not that different. It still looks to me like we're just trailing these other countries by 3 or 6 months. So we'll ultimately get there. I mean, my view on 2025 is still positive, but I'd have to say after such strong returns in 2024, you have to allow that returns are going to be more constrained and probably more volatile, and we're probably going to get a few Trump bumps along the way if he gets around to announcing his tariffs formally, which he probably will.
It sort of seems like US growth is going to slow next year. I mean, they've had phenomenal performance, 3% annual GDP growth basically now up till 2024. When we were thinking about it, we thought it'd probably be closer to 2 or 2.2% at the beginning of this year. So I think it's definitely slower growth in the US next year. I think Australia will perform a bit better, though. It's hard to see things going even further backwards here if we've had tax cut, the likelihood of rate cuts in the next 6 months, and then lower inflation. I think the outlook is definitely better for Australia in the next 12 months.
Yeah, I think it will be, but just got to allow that we're probably not going to get another 15% return year out of Australian shares, just like we're not going to get another 25% or so return year out of the US. It looks okay to me, but it's just, you're going to get that volatility coming out of the US, and geopolitics are still there, as we've seen coming to the end of the year. Issues in France, I think they'll just soldier on with a new government. And eventually you've got an election coming up in Germany, which will probably see the centre-right back in power, leading the coalition. We've got issues in Syria. I know a lot of people get excited about that, but not a lot of oil comes out of Syria. One just hopes that it doesn't turn out to be another case of out of the frying pan into the fire for people in that country. We've got the tensions in the Middle East continuing, Iran, ongoing factors. So all of these things could cause volatility, but from an economic point of view, it still looks okay. Anyway, that's it for 2024. I wish everyone a great holiday season, and we look forward to catching up again in 2025. And a big thanks to Marcel, our producer, who puts these podcasts together.
Yes, thanks, Marcel, and thanks, everyone. Have a good holiday.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.